Welcome to the Why Not Real Estate Podcast, where you will learn top strategies from world-class real estate investors, both large and small. Why not? Tune in and get started today.
Yeah, my advice for anybody today would be, just really think about your personal brand and your presence online and how you're educating your clients, and don't get lost in the weeds. Speak to the client. I think you've done a really good job, Brian, at when we're speaking industry jargon and all, to explain what that means. You know what I mean? And don't just assume, even if you're dealing with accredited investors, a lot of them may have no idea. If they're a doctor or an attorney or a CPA or an entrepreneur or C-level executive, chances are they're very busy in their own life. You know what I mean? So they might not have any idea what an accredited investor means, what that means, what a 506C is or B, or and then all the other, IRR and cash on cash, all the other industry kind of jargon and definitions and things like that.
Hey, what's up, all of my real estate peeps? This is Brian Lucier with the Why Not Real Estate Podcast, where we interview seasoned real estate investors, both large and small, where we believe investing in multifamily is the best asset class out of all real estate, but we always get a curveball from time to time. And today I have a special guest. Maria has been doing a great job in the background. She's my VA keeping the show running. And she made the introductions with our gentleman that we have on our show today. And I'm going to introduce him to you now. So ladies and gentlemen, here we go. Let's get started. So our guest today is one of the co-founders of GSP Real Estate Investors, REI. And he plays an active role in the management of the company and its various fund offerings. He works closely with the company's managing partner, overseeing all aspects of the business, including acquisitions, construction, property, and asset management. Our guest is responsible for fulfilling the company's fundraising goals and manages the company's marketing and branding, including investor relationships. He began his real estate career working in marketing and sales at a distressed mortgage investment company. This gave him the ability to learn all aspects of distressed mortgage business, and he quickly transitioned into investor relations and raising capital for private investment funds. Currently, to date, he has managed the process of raising over $80 million for 6 different fund offerings. That is pretty impressive unto itself. He also actively maintains a real estate salesperson license in the state of Pennsylvania. Hello, Pennsylvania. He's an avid dog lover with a beagle, Becky, and he's a graduate of Temple University. Ladies and gentlemen, all of my real estate peeps, it is my honor to introduce to the show today co-founder and partner of GSP REI, Mr. Peter Neill. Peter, welcome to the show.
Brian, what an amazing introduction. Thank you for that. And I'm very honored to be here with yourself and your real estate peeps. So let's do it.
Yeah, and in the green room before we were getting started up, you mentioned, let's see, right now you're where in the United States?
I'm in the suburbs of Philadelphia.
Suburbs of Philadelphia. I'm just north of Oranjestad, Aruba. And earlier today you were on a call where?
I was in Peru. All over the world today.
So yeah, you're jumping all over from continent to continent, and now you're coming up a little more north, and we'll get you home in time for dinner.
I like it. Sounds good.
So Peter, if it's okay with you, I'm going to jump right in on our questions here. The first one I have, and we alluded to it a little bit in your introduction, and yeah, the introduction. I always get compliments on the introduction, but I always got to put the spotlight back on you. These are your accolades. All I'm doing is reading your story. So if it sounds good, you sound good. And that's why it sounds good. So Peter, I'm going to ask you, can you tell us a little bit about your background before getting into real estate?
Sure. Wow. So I was in college. I worked, like you said in the intro there. I went to Temple University. I majored in broadcast, telecommunications, and mass media. So being on a microphone and in front of a camera is actually a little bit of second nature. It's been a little bit, but I do these a lot recently now. And I took I was on the media business and entrepreneur track. So I worked a lot in radio and television. That's where my internships were and things like that. Growing up, my father was a property manager, a facility manager for CBRE. So before he retired, he was managing Bank of America's. He had a portfolio of Bank of America's throughout Eastern PA and in throughout New Jersey. But growing up, he managed, he was a Pico, which is the local power energy company here. He managed single family rentals through there. They owned property where they had power lines and things like that, and they would lease it out. He managed a lot of office buildings, industrial parks, all that kind of stuff. So growing up, seeing what he was doing, I thought, I don't know if I want to do that. It's like the hurricane. Even obviously we haven't been affected in the Philadelphia area, but the weather here has been very dreary the last few days, and I think it's been like 9 days since we had some, and a lot of rain and things like that. He would be up 2 o'clock in the morning. Snowstorms, he'd be up. I'd hear him in the other room, and on the phone with people, getting people in the right place, that kind of thing. And throughout his career he'd moved up, but still when there was things like that, and bad weather and different emergencies and that, he was always working. And so I just thought, man, I don't know if I want to do that. So when I was in high school, I was the director of the TV studio, and that was just something. My brother actually got me into that, and so that was kind of a natural introduction, to when in going to college and majoring in broadcast, telecommunications, and mass media. And when I got out of school, I ended up taking a job at a distressed mortgage investment company. And at the time, I didn't even know what that was. I think it was introduced to me as, just working for a real estate investment company. And I took that job. It was really close to the house. I could spit and hit the front door. So it was like, very easy to get to. I'd have to drive, all that kind of stuff. And that was an awakening for me. So I was fortunate. It was a small company at the time. They've grown substantially over the years, but I was fortunate to be like the right hand man to the CEO, who was a prolific investor. He had a large portfolio, single family, invested in all kinds of different syndications, and did a lot of lending and stuff like that. So he introduced me to the world of alternative investing and the world of real estate investing. And I never looked back. It was like at that age being introduced to that, and then working in investor relations with people much older than myself. Everybody was like, "Man, you're so lucky to be doing what you're doing at the age you're doing it," and that was something I took very seriously. I didn't want to take for granted. So that was kind of my awakening moment, and it'll be 10 years in November now in the real estate space, and I never look back.
Really interesting story. So I'm going to unpack this a little bit because you have an amazing story here. So Dad wore two hats. One was an investor hat, and one was a light
He
pole.
was an investor. Yeah, my father was not. I mean, no, he was just a facilities manager. The boss at the distressed mortgage investment company, he was the investor. He was the one that introduced me to alternative investing. So yeah,
So
so growing up, my father was a facilities manager, property manager in commercial real estate. So that was kind of my introduction, was just management. I mean, I never knew the ownership side or anything like that.
okay, so that's really interesting. So you learned both sides of this coin. What you were learning from your dad at that time, you didn't know that you'd need to know that later. But
Sure,
the
sure. A funny point too is my mom was a school teacher, so she taught high school for over 30 years, and it's funny, like when I look back to my foundation, and now what I do with like investor relations, which is a lot of education. So it's like on the management side of the business. I have the roots from my dad being a property manager and seeing what that was like and all that kind of stuff. And then, on from an educational standpoint and doing stuff like this, doing presentations and all, my mom was a great teacher, and I could still remember. I went to high school where she taught, so I knew her style and very, very well. So
So this is really cool. I've never had this story on the show before. So the commercial management part of it, after school, the marketing and advertising, obviously that is so critical to any business.
sure,
Then you ended up at this mortgage loan company, not even knowing what it was, became the right-hand man of the CEO's, as your words, prolific investor. And now all these different skill sets kind of put into the blender, and it's like it's the recipe of a cake. And if you missed one of the ingredients, you don't have a cake. And
sure.
you turned out pretty perfect in the different avenues of where you obtained all this information. I mean, it's it's amazing. So my dad was a builder, and
Hmm,
I learned at the kitchen table stuff that my neighbors' kids my age weren't learning. You were learning stuff at that tender age that you didn't know was exclusive privileged information, like specialized information. It was just what dad did.
sure. Yeah, you don't think about it like that at that age, right?
Right, right. And all the time we have these conversations. What were the dinner conversations when you were a kid? It's like your dad's talking about this property and strategy and all this stuff, and you're being exposed to all this at a young age. You didn't know that you didn't know that this was important, but here you are being fed with a fire hose,
Sure.
it in, and here it is years later. It's like, boy, I'm really glad Dad had that experience that he could pass along. So you've outlined your dad, college for the marketing, the um, distressed mortgage company, your mom as a teacher. You blended all this together, got you where you are. What other influences, if there were any when you were growing up, that pointed you to think maybe real estate might be a good investment?
Wow. I think like most people, you drive around and you see, properties, and you think, that those people must have, a certain amount of wealth and, a certain lifestyle that comes along with it. But it really wasn't until taking that job at the distressed mortgage company, they ran an investment club as well. So it was called Strategic Investor Alliance. They brought it was all accredited investors, and they brought all kinds of different opportunities in through that. And that was just such an eye-opening, awakening kind of a moment. And that's when I thought, this is real. I mean, this is something that I can actually do. You don't need to be a multimillionaire to own real estate. You can leverage your goals and or your skill set and what you're good at and all that kind of stuff with other people and what they're good at. So that's one thing that's always partnerships and staying in your lane and knowing what you're good at, what your strengths are, and then leveraging other people and their strengths. That's always been a very important thing to me. So but to get back to your question, it wasn't really until like those passive investing, networking kind of groups and presentations that and just and raising capital, and meeting a lot of accredited investors, talking to them, talking about their goals, having similar conversations that we're having now, how they got into the space, all that kind of stuff, and realizing they're just like anybody else. They obviously have certain skills and they do certain things that maybe they realize or don't realize, but they have a strong work ethic, they have a good, mindset and perspective on life, and can face challenge as well and take risk and all that kind of stuff. But I was able to realize they're just like anybody else. They put their pants on in the morning like anybody else, and not everybody's like that. I mean, I remember we had a person on the IR, the investor relations team, who was really intimidated talking to accredited investors and raising capital and stuff like that, and it's just that I guess somebody, they're a wealthy individual, they're a millionaire, multimillionaire, and I never felt that way. I always I've always, people are always, typically pretty kind, and and if you ask the right questions, those people, just like anybody else, they want to talk about themselves and their story and how they got to where they are and all that kind of stuff. So I think it was actually being in the space, seeing other people doing it, that I thought that this is doable. I can do this myself. And then, having a strong mentor was certainly helps to make things practical as well. And kind of when you have questions, have somebody to go to, that kind of thing. And so that was definitely a game changer. And I was very fortunate to move from employee to starting GSP, within a little bit over 4 years, and it happened quicker than I thought it was going to. And it's kind of it's so important not to take for granted the opportunities, and try to make the most out of them, and learn, and reevaluate and all that kind of stuff on a regular basis.
So you've mentioned the term a few times, and I want to put a spotlight on that. You've mentioned accredited investor. Now,
Mm.
you and I, we know accredited investor, we know sophisticated investor, but someone who's watching this for the first time, who just stumbled across this and heard that term, could you give us a little bit of what is an accredited investor, what's the parameters, what's a sophisticated investor, what's the parameters, and why is that important?
Yeah, so a really good question. The An accredited investor is somebody that has, it's an individual with a net worth of $1 million, not including their primary residence. So they can go by the net worth test, or they can go by the income test. That would be you as an individual make $200,000 a year for the last 2 years, or with your spouse combined, you make 300,000 or more for the last 2 years. So that's kind of the net worth and the income test. You don't have to meet both, just one or the other. There's a few other ways you can meet it too, with like if you're a partner in an entity where everybody's accredited, or you have a 5 million in assets, something like that. And then there's different licenses you can have where you can meet it as well. Now, I don't deal with sophisticated investors as much, so I don't want to give wrong information. I'm not sure exactly what the definition of a sophisticated investor is. Maybe you could tell me.
Well, I know from creating a property placement memorandum or something like that, if you're all accredited investors, you could probably save about 30 pages.
Sure.
Whereas if you're doing a sophisticated investor, you have to spell out every risk.
Oh, okay. Okay.
A sophisticated investor would be someone who obviously doesn't qualify with the financial acumen for an accredited investor. So you have to be more careful when you take on the sophisticated investors, because you don't want to put someone's entire life savings where they're at risk and could lose everything. It would almost be better to say, look, this might not be the deal for you. Let me find something a little less risky.
Yeah.
So
Yeah.
sophisticated
And I
investors.
think that's like the whole reason why the SEC does that. I mean, because I've get questions over the years, like, is that something that we're saying, oh, you have to meet this? You know what I mean? But when you, with the fund, the way the funds register, which we do all 506C funds, you have to be accredited. We have to have documentation on file showing that you're accredited. And what you're referring to is a 506B fund, where you don't have to have the documentation on file, that you can't generally solicit. So you have to have a pre-existing relationship, and you can have non-accredited investors, sophisticated investors. I think it's like up to 35 or something like that. So I've
So,
never done it. I think maybe when I first started, one of the funds we raised for was a 506B, but I think all the funds I've been involved with over the years have been 506Cs. So you have to be accredited, and you have to have documentation on file to show that.
so you've given us another pearl of wisdom here, and I'm going to unpack it for our guests. You have your 506C, your 506B, and I'm going to throw in a Reg A,
Yeah.
which I like to call Reg A. Hey, I'm here on the
Yeah,
app.
and Reg A, yeah, and everybody, I think, non-accredited and accredited can invest in Reg A.
Right, and that's kind of a different hybrid kind of crowdfunding thing
Crowdfunding type.
that
Yep.
developed maybe 5, 6 years ago ish. So the 506C, the way I always remember that is C is a corporation or commercial. So this is going to be coming in as a business or an entity or something like that. Like any of your accredited investors probably are going to come in as an entity to have that barrier of risk. I mean, you may have
Yeah.
people who've done it
You
differently.
can certainly invest personally, and your risk is going to be limited because you're coming into an LLC. I mean,
Sure.
so you're protected by that LLC that you're investing in, but for tax purposes, I think you'll see people come in through LLCs, and well, I'd say probably half of our investors are through LLCs, whether it be a personal entity of theirs or they're investing through a retirement account, which is structured that way. And then the others are just, in their personal name. And I think for tax purposes with depreciation and stuff like that, if it's all coming through an entity, then you can use that depreciation to offset other passive income you have and stuff like that. Where if you do it personally and real estate's not your full-time thing, then you can't do that and stuff. But I'm sorry, I'm not a CPA and not the not the expert on that stuff.
Yeah, there will be a disclaimer at the beginning of this show saying that, we're not lawyers, we don't play them on TV or anything like that. And I just want to flip the coin to the 506B. This is the way I categorize it and remember it in my own head. C is the commercial or the corporation or the business part of it. The B, I think of my boys or my brother or family. So the B I relate to, this could be something where I offer it to my uncle or my son or my cousin. That I find a lot of investors doing their first type of syndication will probably go through their Rolodex and invite everyone they know
Sure.
just to
Yeah.
get it funded. So that might be a 506B. And then later, when you've got the track record, when you've got the traction as you do from your decades of experience, you're staying at the 506C because it's just easier for you to do that.
Yeah, yeah, and you can generally solicit, so you can put information about your fund and your returns and things like that. You talk about them in presentations or on a podcast. You can put it on your website. In a 506B, like you were saying, you're supposed to have that pre-existing relationship,
Sure.
and it's one of the reasons I think you see a lot of real estate like syndicators and fund managers do courses and things like that. It's because if you get into a course and you're in that course for a few weeks or a few months or something like that, now they can say we had a pre-existing relationship. This person was a member of my course, that kind of thing, because you may have to prove it, I guess, at some point to the SEC if you have an issue or something like that, where they want to see how do you know that person and that you didn't just meet them today and you're saying here's my fund documents and come invest in our fund. There needs to be something, some kind of pre-existing relationship where in a 506C, you can generally solicit, you can, give the fund documents, online and things like that and all. But you're verifying in documentation that the person is accredited. Whereas in 506B, they fill out a questionnaire and they kind of self verify.
I would even add a layer of caution to the 506B. Sure. I mean, I've got this podcast. You're coming on. I don't think it would be prudent for me to throw a deal to you if we had not had a discussion about, Peter, what type of deal are you interested in? What are your risks? What are your returns? It should be more than just, oh, you signed up for my class. We have a pre-existing relationship.
Sure,
I
sure.
understand you as an investor.
Yeah.
I mean, where are your boundaries? Where you want to be? What are your returns? What's your comfort level? And if you're my grandma or somebody's great aunt, I shouldn't be throwing you into a syndication that's high risk. If you've told me, well, you might want to start off with a three family. So,
Yeah. Oh,
so
yeah, yeah. No, you hit the nail on the head, and that's what I was envisioning with the course is something where, yeah, you're spending weeks together, on a weekly basis, having conversations and all that kind of stuff before you're throwing that
yeah,
kind of out there. So there could be, I think there's reasons people do either one, and the C involves some more, regulation and having to do those verifications and things like that, and there's third party firms you can work with to do that, like Investor Verify and that kind of thing. And it adds an expense that you can either take on or the investor can. And so it's just there's certainly ways that you can operate in both sides of the world, but and depending on what your goals are and things like that, one may be better or worse for you.
Good, good. So I've got you 10 plus years as an investor. Now you have your own company doing all that. We're going to get to that. But this question is kind of fun for me. I always enjoy this one. This one has two prongs to it. So if you could go back in time 10 years when you started,
Mm,
what advice would you have given to yourself when you were starting? And the second prong is someone seeing this for the first time, hearing this information for the first time. What advice would you give to that newbie on the fence today to get started? So we'll do you first. What advice would
sure.
you have given to yourself 10 years ago?
Yeah, well, and the advice would probably be the same for each, but I think having a personal brand and being consistent with it over time, doing the social media stuff, creating content, creating educational value, staying in touch with people, building your email list. Obviously with my core focus being investor relations and raising capital and satisfying our capital needs. I mean, that's what I'm going to lean towards is, having a personal brand and just staying consistent. And just having constant conversation with investors and that kind of thing. I think that's so important. I over the years, being on the operational side, I've taken time where I'm on projects on a daily, weekly basis, learning the construction side of the business, learning the property management side. I think that's extremely important. I think that's what makes a good capital raiser, a good fund manager. You really need to understand, everything in the business. You can't be like if you're in construction, you can be in construction and you should really know how to be in construction and manage the crews, manage, just the jobs and subcontractors and the purchasing and all that kind of stuff. But when you're raising capital, you need to know a lot about a lot. It's just like, and I learned that at working at the distressed mortgage company. We had an educational arm and when I started in sales and marketing, so I was selling those courses, and then they had weekly calls and things like that. So I was really able to learn how that business operated and how, back in those days, it was a lot of second mortgages. So kind of like the collections and things like that. So workout agreements and then, dealing with the states and servicers and the CFPB and like all those different, kind of things that were involved. That's going to make you a better capital raiser. That's going to make you better at investor relations and all that kind of stuff because people investors are going to have questions, right? And if you can't answer them because you don't understand that side of the business or something like that, that's a problem. So I think it's very important that you're kind of working both angles, where you're learning the operational side of the business and you understand, the acquisitions, and the execution side, whether it be through construction or property management or whatever it is, whatever the strategy is. But I really think, you can't just create a reputation and a personal brand overnight. That's something that builds up over time. So it's one of those things where it's like, when's the best time to raise capital? It's 20 years ago. It's like, when was the best time to plant a tree, right? 20 years ago. And if not today, I mean, so moving to the next thing, my advice for anybody today would be, just really think about your personal brand and your presence online and how you're educating your clients and don't get lost in the weeds. Speak to the client. I think you've done a really good job, Brian, at when we're speaking industry jargon and all, to explain what that means. You know what I mean? And don't just assume, even if you're dealing with accredited investors, a lot of them may have no idea. If they're a doctor or an attorney or a CPA or an entrepreneur or C-level executive, chances are they're very busy in their own life. You know what I mean? So they might not have any idea what an accredited investor means, what that means, what a 506C is or B or and then all the other, IRR and cash on cash, all the other industry kind of jargon and definitions and things like that. So, speak to your client and just try to provide as much value as you can up front before you try to sell anything or anything like that. So
Yeah. A wise man once told me, a confused mind says no.
sure. Yeah. No, I've been hearing that a lot lately. That's funny. That phrase, I've heard that a good couple times. It's great advice, and it makes sense. It's like the Einstein thing. You got to be able to explain it to a 5-year-old, and if you can, it's then you probably might not understand it yourself. You know what I mean? So I think it's important. I like to look at real estate in three buckets. There's capital, acquisitions, and execution. And I think you need to know something about all three of those, and whether, and you might be, your lane might be one more than the other. But I always think it's important to have a well-rounded, understanding of all three of those spaces. Capital being, raising capital and, but the equity and the debt side of things, the full capital stack. Acquisitions, obviously, working with brokers, finding off-market deals, depending on what your strategy is. And then execution, being so having a business plan, having it spelt out, and then executing on that, whether it be through construction, property management, whether you're doing it yourself or you're working with third parties and all. So there's like everything I feel like in the real estate space falls into one of those three buckets.
Absolutely. And just for anyone listening, again, capital, acquisitions, execution, all the way to the disposition of the property, and then you get to do it again.
Exactly. That's your execution there, depending on what your plan is. If you're buying and holding, and you're going to refi and put long-term debt in place, or if you're going to sell the property, that kind of thing, depending on what that goal is.
So this is a great segue, and you set it up so perfectly for us here. So the next series of question is we're going to talk about a deal. So I love to ask what type or what was the best deal you've ever done? What type of property was it? How did you find it? And how did you finance it?
Yeah. So I mean, I look at everything from a fun level, you know what I mean? So, GSP REI is the best deal I've ever done, and the funds that we manage. We have a very particular buy box, you know what I mean? So we've over the last 5 years, we've bought and sold over 200 deals. Um, Pretty much all of them fitting in our current buy box, which is all in for 130,000 or less. Sometimes a little bit more, but if the ARV justifies it. But we like to typically see an ARV of about 185 on the low end to 200 or so. Plus is great. And then we'll put a tenant in. It's usually right now it's about 1,700 in rent. Uh, on average, use about 1650, but rent in our markets are still increasing. And then we'll put long-term fixed rate financing in place. So through our funds, the capital we raise through the funds, we use that for the acquisition and the construction costs. We like to purchase in cash, renovate in cash, and then put long-term 30-year fixed financing in place. So any kind of deal like that where we can be all in for a buck 30, get an ARV of 185 plus. We're getting almost on a 70% loan to value refi, we're getting almost all of our cash out of that deal. Sometimes we are getting all of it out. Sometimes we're maybe leaving a couple dollars in the deal, a few $1,000s, a few hundred. So from a risk perspective, we're in a very good position. We have very little money in that deal. And then we have long-term fixed rate financing in play. It's the Burr method essentially, and then we just rinse and repeat. So that's one of the things we like about single family. Why we tend to focus on single family. But I do like to say we like to take a commercial approach to it. I think that's very important. A lot of times, like I think people look at single family differently, like for their own personal portfolio. Well, I get it starts to be kind of after you get five, say 10 deals or more, and you're working a regular job, and you have a bad tenant or two, it starts to become a pain in the butt, and then when you have a portfolio like that where if maybe you're doing everything yourself, which you're getting great pricing that way. You're not, you're not working with a GC or a handyman or something that's charging ridiculous amounts on top of materials and that kind of thing. But now it's not so passive anymore, I mean, it's becoming like a second job, a very intensive side hustle, that kind of thing. The way that we like to look at it is more from volume. And if the larger the portfolio is, the more diversification we have. You're going to have tenants where things don't go the way they're planned. You build that into the system. And then, you look at things from a professional landlord perspective as well, you know what I mean? And not just like a mom and pop type owner too. So I think, just I look at it more from a fun perspective, and I like what we're doing now in our model with workforce and affordable housing. A lot in the markets we're in, there's really strong demand for rentals, for resales. So that's what I would say. Anytime we can go in and we can stay in our buy box there and get almost all of our cash out of a deal and rinse and repeat, that's a good day for us.
So there's so many branches on that tree, but I'm gonna stick close to the trunk on this one.
Okay.
So when you started to tell me your buy box, all in for 130, ARV 185 to 200, automatically I knew you were single family. And then
Sure.
as you unpacked a little bit, you mentioned, yeah, single family, workforce housing, affordable housing. So now I want to stay on the trunk and talk about this. You're saying you see it as a fund. So
Sure.
in my understanding, and correct me if I'm wrong, I don't mind being wrong. I'd rather be educated. So I'm an investor coming into your deal. I've got 200K. Another one's got 550K, whatever it is, right? So as a fund, explain this to someone who doesn't know how this works, and I'll raise my hand. I don't know how it works.
Mhm.
So you're gathering a fund that would be X amount of dollars, and then you're going to go out and buy a portfolio of houses. Is that
Oh,
kind of
we'll buy one off. I mean, we certainly buy portfolios, but we'll get better pricing on one-off deals. A lot of times the portfolios are cash flowing to some degree. So you're paying a little bit of a premium for that. Whereas we like to buy, one-off individual dilapidated homes, and that tends to be where we're getting the best discount. And then we're going in and taking it down to the studs or even the brick and just rebuilding a new home within those four walls. And the way that our fund works, I would compare what I like to say to kind of to somebody new to it would be it feels very much like an in-house private credit fund. So when you look at private credit funds, hard money funds, lending funds, they'll take capital in and give a preferred return of maybe 6 to 8%, and then upside will get you to about 10 to 12%. And they take the cash in, and then they lend that out to somebody who's doing fix and flips or somebody who's doing buy and holds. What we do is we raise capital through our fund. Everything we buy is through that LLC, so you're collateralized to the portfolio. And now when you sign the operating agreement, you become a member, so you're collateralized to everything that the fund owns. We use the cash to purchase and then renovate the property, and then we put long-term financing in play. But for the investor, it's a fixed rate. It feels like a fixed rate return. So instead of getting a 6 to 8 pref with 11 to 12 upside, we lend the money out to somebody else. We do all of the work ourselves. So, we're not working with another investor. I mean, we are the operator, we are the investor, the developer. And then we pay a fixed rate of return depending on how much you invest and the term that you invest for at 10 to 12%. So it's a consistent payment that's distributed on a monthly basis, or they can compound depending on what their goals are.
so this could be a hybrid, but I'm going to throw it out there. It sounds like a debt position
Yes.
with a little bit of spice one way or the other.
It's equity that feels like debt. So
Wait,
technically yeah.
okay, now that was really good, but I have to ask because I need to understand it. I'm the
Mhm.
investor coming in. Am I coming in a debt position? Am I coming in an
Your
equity?
common equity. Yeah, I mean, so yeah, your common equity. Yeah, another way to look at it is it kind of feels like preferred equity, because a lot of times preferred equity will have a fixed term and a fixed rate. but the whole preferred equity is you're in a preferential position over common equity. For us, there's only common equity and then senior debt, and occasionally we use bridge financing. We have lines of credit with our lenders. We'll occasionally use it for construction, that kind of thing if a project warrants it. But for the most part, we're purchasing in cash, renovating in cash, and then we put that senior debt in place. So we'll put that long-term 30-year fixed, 30-year AM debt in place. So the capital stack is typically just the senior, any bridge, and then you have the investors, in common equity, but it feels like debt. So the investor is receiving a fixed rate return for a fixed period of time, and then so it's like an interest only payment to them, and then they get a balloon payment of principal at the end, or they can keep it rolling, and continue to invest whatever they want to do. So yeah, it's equity that feels like debt. Now, where the equity comes into play is if we miss a payment, we have 60 days to write that. And that's never happened. And I mean, we've always, paid our promised preferred return. But the way we set it up, though, is it kind of feels like a deed in lieu. So our investors take control over the assets in the fund. They could hire fire management, they could liquidate assets, that kind of thing. And really, truly, our payday is the assets remaining in the fund once we've paid our investors back. So we set it up where we're paying a fixed rate return that we feel confident and comfortable that we can continue to pay. And then if for some reason we don't make a payment, we're losing control over the assets in the fund. It's the last thing we want to do. But at that point, investors would own 100% of our portfolio. So that's really when the equity comes into play. If for some reason we don't make a payment, that kind of thing. But other than that, just fixed rate, fixed term. And at the distressed mortgage company, that was how our funds were structured. So I knew a lot of investors that liked that structure. They like the predictability of it, from a cash flow perspective. It doesn't generate UBIT in a self-directed IRA account, which tends to be issue with hard money funds and syndications, where with how they utilize debt and things like that. So people like it in from a self-directed IRA perspective and all. So it's that was kind of where that fund came out of. Now we do have what we call our growth fund, which is more of a traditional. We pay a six pref and then we split profit and equity and tax advantages 50-50 above that. So we kind of have funds, depending on what type of investor you are, what goals you have that could possibly meet your needs.
That's so interesting. So I'm going to do a apple to orange comparison. So your fund sounds fun. Um, so first, I'll approach it from my world. We do a syndication. It's a complex or a property that holds
Yeah.
a value, and then everything is based off of your prefs and everything based on the performance of that property,
Yep.
which I understand that. Now I'm looking at your fund. I did the rough numbers based on your holdings here. At one point in time, you had about 400 houses.
Yeah, we've
Okay.
through our funds. I mean, we like right now our rental portfolio is about 130 doors. I mean, and so,
Some
but
complex.
like throughout the years, and prior to GSP, we've managed over 1,000 homes. My partner Wade had a 750 unit single family portfolio at one time. So,
Okay, now let's get to the apple and the orange comparison. So I've
Mhm.
done my complex. I know how that works. My returns are based on the performance of that address. Now, let's say one of your
Mm.
funds has 20 houses in it. So how do you blend all that so the investor, I mean, isn't looking at 20 different spreadsheets saying, well, this one did good, this one not so much, this one had an eviction, this one had a fire, whatever it is. How does the investor make heads or tails being in a fund if it's, and I'm assuming multiple assets in that?
Definitely,
How does
definitely,
that
yeah. So we do quarterly financial statements. They get a balance sheet and a P&L. And the entire portfolio is represented through that balance sheet and P&L. On a kind of a deal level perspective, we do provide a portfolio review that gives them, here's what's in each fund. Here's the basis for it. Here's what it's rented out for. Here's what's in construction. Here's that kind of stuff. So it's kind of two separate things. I mean, so the P&L and the balance sheet. involved is the entire portfolio. And I mean, so it's everything that that fund owns. So to your point, I mean, your cash flow is going to be, your revenue is going to be reflected on there. You know, the portfolio value, the debt, all that kind of stuff is reflected on there. And then the portfolio review is what gets into, you know, kind of deal level, what that fund owns, where it's at in construction, and from what's leased to what's turned over, what's in construction, all that kind of stuff.
Okay, that is so cool. The way you explain that, this 3-year-old understands. So,
I do try to pride myself on you know, making sure people understand what they're doing. You know what I mean? Because and it's tough. You know what I mean? Not everybody, and I don't blame them. You know, everybody has their own thing and what they do in their full-time job. But it's really important to me. I'm not the kind of guy that likes surprises. You know, so I really like to make sure our investors know what it is that we're doing and why we're doing it that way. And so I appreciate you saying that.
no, no, no. And I'm going to add a little bit of frosting on top of this cake. So for that investor, that doctor, that dentist, the butcher, the baker, the candlestick maker who's investing in your fund, the PL sheet, okay, that prevents all the brain damage for the
Sure.
investor because I can look at it. It's one piece of paper.
Yeah, it's consolidated. Yeah.
Yeah, what came in, what came out, and here's my numbers, here's my return. Easy, I can figure this out over a cup of coffee and a bagel,
Yeah.
right?
Well, you know what we do too, Brian, is we do management review calls. So we send those financials out typically a week or two later. You know, we give everybody time to look at them. And then we get together, we walk through everything. You know, like I said, we don't want surprises, you know, and we understand too. We have some very, very sophisticated investors that are in many, 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 many deals. But we have other investors who we're the only deal, you know, or they have just a handful of deals. You know what I mean? So we take the path of let's act like people have no idea what they're looking at here, and let's walk through everything. We do a pretty extensive write-up in the beginning of those financials to kind of just speak to the overall activities of what we did. And then, you know, what we're seeing in the market, you know, from a micro perspective, you know, because so many investors look at the market as a whole. You know, they're reading information online that kind of aggregates data from all over the country. A lot of times, investors confuse what's happening in the commercial world with what's happening in the residential world, and I see that all the time. You know, I'll see that on CNBC or, you know, Fox Business or something like that, where somebody's speaking to something happening in multifamily or commercial as if it's affecting residential, and there's just a big difference. You know, so in the financing's different, the supply and the demand's different, all that kind of stuff. And it depends on like where you're at geographically too, in your market, and how much development there is, and national attention from investors and things like that. So we speak to our markets and what we're seeing in boots on the ground wise, and then we walk through the P&L and the balance sheet line by line, explaining everything. So everybody understands, there's no surprises, that kind of thing.
So without drilling deeper into this well, this is really good. I'm really enjoying this show.
Sure.
You're teaching me a lot. I like that. So the best type of deal you ever did was the fund. What type of property was it? A multitude of single
Sure.
family homes. And I'm sure we could talk another half hour on how you source those, but we'll save that for
Mm.
another show. And then how did you find it? Well, that's kind of in there as well. And then how do you finance it? Joe Investor, butcher, baker, candlestick maker, dentist, doctor, come in, fund the deal. You, as you just said so eloquently, you explain how they're going to read this information, and then they can decide yay or nay, I'm in or out.
Yeah.
So
Yeah.
that was the first time we ever had to unpack a fund as the
There you
best.
go.
Yeah, this was good. This is going to be
Yeah,
good.
I like to say, you know, we take a commercial approach to the single family space. I think that's so important. I've had investors say to me, like, when does the portfolio get too big? And it just, we would never look at it that way. You know what I mean? Just like the benefits of scale in multifamily, there's massive benefits to scale in single family, especially if you're doing things right. That's not for everybody. I wouldn't suggest anybody to just go out and start buying as many single family homes as they can. You really have to have a strong foundation, and we do all of our construction and property management in house. Some of the guys on our crew has been with my partner Ron for over 15 years now. So we have a really strong foundation in that space. If you don't have that foundation, it's going to be hard, especially when you're working in workforce and affordable housing areas, finding good contractors, keeping them busy. That's another reason why you want to operate at scale. You don't want to lose guys, you want to keep them working. And then just making key in-house hires. We don't look at this as a portfolio. We look at it as a business as well. I mean, so we're really fortunate to have a really good team around us. So like my partner Ron is the managing partner. I work with him on a daily basis, like you were saying in the bio. And then we have really good people in place. My partner Brian runs construction. We have Edwin, who's on in the Philadelphia and the South Jersey market. Gilmer, who's in the Baltimore market. John is my partner. John's doing property management, overseeing both markets. And then we have Richard in Baltimore who oversees that market and boots on the ground there. So we have a really good team in place to do what we do. And that's one of the reasons we focus on single family, because we can execute in that space. I think a lot of times multifamily, especially for the individual investor and syndicator, that makes sense. I mean, because they can leverage their skill sets and underwriting and due diligence and analysis and leverage brokers and that kind of stuff to find deals, and then they can kind of manage the managers, that kind of thing. But for us to be successful, we found doing that stuff in house is a really good way to do it. And with scale, you're always going to have problems and things like that. Scale allows you to absorb any issues and that kind of thing, and it does create an economy of scale. We're never buying one refrigerator or just a couple boxes of flooring or something like that. I mean, we have a warehouse, and I mean, we have we were just joking the other day. I mean, we have supplies spread all throughout the mid-Atlantic, in garages and in some of our warehouses and things like that. So we're getting great discounts, bulks, wholesale discounts on stuff. And
Yeah.
but what we do too is very cookie cutter, and it's very systematic, for what we're putting into properties. So our guys, they know what they're doing. That's why we kind of like those dilapidated homes versus the value adds, where it's like, even like Gilmer, 30 years in the business, it's you don't have see-through vision, you know what I mean? So he's like, you might think a budget's 25,000, get a wall open, find a foundational problem or something like that, and it's more, when you're buying right and you're rebuilding within the four walls, kind of a thing, and you buy right, it's practically new construction you're handing over. So it's a good way to do what we do. So
That was really interesting as you were going through your team. I'm like scanning the website at the same time. Okay, there's Brian. Yeah, there's Wade. There's Pete. There's you. There's Ron. Everybody. But I guess the one unsung hero that you didn't mention, who really keeps everybody on the ball and keeps their tail wagging and taking
I
constant
was
steps,
gonna say, I know what's coming.
would be Bodie.
Bodie, yeah, yeah. So GSP, people ask me that all the time. It stands for German Short Hair Pointer. Everybody knows German Shepherds. A lot of people know GSPs, but it was one of those. We have a diverse background in real estate, and we have big plans moving forward. So we didn't want to call ourselves the Workforce Housing Fund or something like that. So we went with GSP REI. And those dogs, if you know them, the energy on them is just unbelievable. Yeah, I mean, just and really good companions, really good hunting dogs, work dogs. So there was a lot of similarities between our personality and our mindset, and how we take it to the business. So that's why we went with GSP REI.
Yeah, and Doghouse REI just kind of sounds a little negative at some point. So yeah,
Yeah, yeah.
it's cute. You people on the show, if you're watching this, I'll make sure the links to their website. Go to the team and just go to the bottom. Actually, he should be on the top.
Oh, it was hard getting that picture. He's insane. But yeah, and I have a beagle myself, because when we started the business, I wanted to get a dog, and Ron has two, Wade has one right now, and he's had him his entire life, and always like a family dog. And both of them were saying like you're not going to be able to start this business and have a GSP like a puppy. It's just they're too insane. So I got the Beagle. She's the perfect mix of hunting dog and a lot of energy, but at the same time, I don't think she got out of bed today until 12 o'clock. She, especially on like a dreary day like today, she can sleep like no one's business. So, and as somebody who's busy and on the phone a lot, I can appreciate that. And then get her out after dinner, and she drags me all over town with the nose. Oh my God.
So, as a real estate investor, what's the biggest hurdle you've had to overcome, and how did you solve it?
Wow. I mean, that's a really good question. I think you face hurdles on a daily basis, in different ways. I think just making the transition from being an employee and working at that distressed mortgage company to starting my own fund, uh, you know, getting the right partners in place. But I wouldn't say it was a hurdle. I mean, it just happened naturally, though. Like I wanted to get into a sports complex development here in the Philadelphia area, and I had some connections to kind of make that happen. And Brian, who you're seeing on the team there, I worked with him at the distressed mortgage company, so that's how we knew each other. And he played minor league baseball. He might have touched the mound for the Pittsburgh Pirates for a little bit. Blew his arm out and got into real estate and that kind of thing. But he introduced me to Ron because Ron he sits on the board of a sports marketing company. It was a company he invested in years ago, and he sits on the board and he helps them out in various ways. And so we got together talking about sports marketing, and how his connections could help get this complex off the ground. And when we got to talking and getting to know each other, I was asking what he did for a living, how did he make money? And he started telling me about what he was doing in affordable housing and workforce housing. And back in those days, he was fixing and flipping a lot of homes in New Jersey, getting them from government service entities.
Oh, yeah.
And I said, "Oh, where are you getting the government service entity product?" And he said, "A guy named Wade Carroll." And I known Wade for years. Wade was the distressed mortgage company had a joint venture with Wade, so I knew Wade very well, and he had a really good reputation. He's kind of a legend in the distressed mortgage space with working with HUD and doing what he does with nonprofits with HUD and all that kind of stuff. So when I realized that, it was like, wow, small world. We know a lot of the same people, and I thank God every day that I ended up partnering with them and co-founding GSP REI instead of doing the sports complex, because when COVID hit, I'm sure that would have went under. I mean, it would have either never got off the ground or it wouldn't have been able to make it because at that time, kids weren't, this would have been for like kids, high school kids, stuff like that in the Westchester area. And, all that stuff was pulled for a good little bit. So I was really fortunate. I liked workforce and affordable housing. As a fundraiser at heart. You look for something that isn't extremely cyclical, and a lot of commercial can be very cyclical, and with supply and demand and interest rates and things like that. Workforce and affordable housing, the demand is so high that it's a little bit it's isolated from a lot of the craziness in the real estate market, and there's nothing happening on a federal, state, local level that's adding to the supply in a drastic way or anything like that, especially in urban areas where it's the built environment, and it's just and the only new supply that comes online is in apartments, and a lot of people, especially we deal with a lot of families and all, they want a single family home. They want that kind of space, and the privacy that a single family home provides. And it's something where there's institutions that do what we do, but it's difficult because it is the built environment and you're redeveloping existing product, whereas you tend to see a lot of the institutions go down south and in other markets where they can buy these huge tracts of land and do these built to rent communities and things like that, because it's just they can work more succinctly and that kind of thing. So we have a very specific skill set that we've developed over many years, way prior to forming GSP REI. So we do what we're good at, and hope to do more of it. And it's an impact investment that provides, our slogan is rebuilding essential homes for essential workers in essential communities. So, it's there's a lot of impact to the people that we deal with, from the tenants, the investors, and then the communities as well. So you can feel good about what you do. I love that about what we do.
Fantastic. So to sum up, the biggest hurdle was employee to employer, and
Hmm.
network of people actually became your net worth of people.
Sure. Yeah. Yeah, I was really fortunate to have we're a really good core group of people that champion me and what I'm doing and that kind of thing, and followed us throughout the years. And relationships are everything in this business, in a capital acquisition and execution perspective. Every bucket relationships are going to make you or break you.
That's true. That's true. In such a big way. So you went to college, you got educated, you're marketing guy, all that. When you turn the page, you see where this is going, to get into real estate. Was there a book that really influenced you to become a real estate investor?
Wow.
Don't
You
worry,
know,
it's get harder.
yeah, I look at it in different ways, and I look at things from a capital raising perspective a lot. So I
Okay.
would probably say the book that was Win Friends and Influence People. I think that was a big one. I mean, God, there were so many books. That's a really good question. There were so many books back in the day that opened my world to what was possible, and kind of tools in the tool belt, from using other people's money, and crafting creative financing deals and things like that. Just books that, and not all of them have I even put into to actual. I've used them in my career or anything like that, but they planted a seed, and they gave you an idea of what was possible, with subject to deals and all kinds of stuff like that. So there's so many, and God, I haven't looked at them in a long time, but I do buy books all the time. I just bought another one last night. God, I don't even remember the name. But so I'm always reading something. Right now I've been reading a lot of copywriting books and stuff like that, as we look to do more on social media and LinkedIn and stuff like that. That was like a skill set that I never really thought much of. I mean, that I've just been getting into, and how to write more effectively from an ad perspective and sales perspective. And nowadays, people's attention spans are so small, right? With social media, how do you grab somebody's attention, in a split second? So that's been a focus. But I just bought a real estate book. I can't even remember the name. I think it was like finding success, 4 things of finding success in real estate. It was written by a Harvard professor. And so I'm always reading books, and I do courses and stuff like that. And there's always something to be picked up, some tidbit you can take with you.
So the book by Andrew Carnegie was How to Win Friends and Influence
Mm,
People. And when people hear that
Dale
title,
Carnegie.
yeah, oh, Dale, I said Andrew, my bad. Sorry, Dale.
Andrew Carnegie, that's the Think and Grow Rich. Wasn't that written by God, what was his
Napoleon
name?
Hill.
Napoleon Hill, and he studied Andrew Carnegie. I think it was one of his people that he studied.
Yeah. So when people hear the win friends and influence people, the perception is that that's about manipulating people, and that's not it at all.
No.
It's getting one on one with people and being present with who you're talking to and understanding who they are, where they are, and meeting them there. That was a really good book.
It's
Uh,
funny you say that as I'm sending a text in the background, but yeah.
no, that's okay. That's okay.
But yes, 100%. I mean, that's one of the, and there's like a whole structure to that book, and I have it printed out. I used to keep it with me. I was doing some remodeling here, but that's one that I just go back to all the time. But yeah, it's yeah, I think it's so important to meet people where they're at, and I think in the longer you're in real estate, the more you're in this space and your network, and so many of the people you deal with in your life or in real estate in some way or the other, you forget what it's like for somebody who's new to the space or something like that. So I think it's important to meet people where they're at, and I think the way you do that is by asking really good questions, and like you said, being present, listening to them, and trying to. I think that's one thing I do very well, is meeting people where they're at, listening to them, what their experience is, what their background is, and then getting on their level, and explaining things in a way that hopefully they can understand it. There's emotional investors and there's logical investors, and everybody's a little bit of both, but some are more than typically lean one side or the other. So like when you're dealing with somebody who's an engineer, typically they're going to be very logical. They want to hear the numbers, they want to hear how your systems and processes, all that kind of stuff. Whereas when you're dealing with somebody who's more on, like on the emotional level, like an entrepreneur or a salesperson or something like that, they want to know who's the people, what's their background, what's their track record, what mindset do they bring to the table, all that kind of stuff. So it's important to kind of, work with, both sides are very important. But it's rare you talk to somebody who is split down the middle where they want to hear. I mean, they usually lean more towards one or the other. So you want to know who you're talking to, and present what it is you're doing in a way that, they're going to understand it and all.
Very, very good. So I usually ask for a second book recommendation. And if it's okay with you, can I throw one in?
Yeah, please do.
So, based on what you just said about one thinks one way and the other thinks the other way, I have been devouring Thinking Fast and Slow
Hmm.
by Daniel, and I'm totally going to butcher his last name. Yeah, I can't think of his last name, but he talks about system one thinking and system two thinking, and you just described it perfectly. I'll make sure that I send you
I'll
the
check it
note
out.
on that book. It's Thinking
Oh, great.
Fast and Slow. It's a white book with a pencil chewed up on the cover.
It sounds really familiar. That name sounds really familiar.
Yeah, he won a Nobel Prize in economics, and I'm reading the book to dig deeper into why people make certain investment choices
Okay.
and
Yeah,
how I can make better investment choices.
sure.
That's, I'll throw
I
that
love
in,
it.
and I'll throw you a life raft, and I'll put the second book in there for you. So
Perfect.
I'm trying to be sensitive of the time here. I know that I've got you for
Okay.
just a few more minutes. So what's next for you in real estate, and why not get started today?
Wow. I ask myself why not every day. I think that that's part of the purpose. And I mean, you want to have a really strong purpose and a strong mission. And I think what's next for me is continuing to do what we do, and just continue to improve and do it better. I think it's very important to have a singular focus to some degree, and do something and do it very, very well. But I also understand, there's a point of diversification is key as well. And there's only so much I can do too. You know what I mean? So I'm always looking for, other operators to invest in, deals to invest in, and things like that. So as to, and I'm my background is not just in residential too. I mean, I have my license, like we talked about before. I hang that at a commercial broker. I spent a lot of time in commercial brokerage to understand how to underwrite, how to do diligence, how to analyze, what investors that we were working with, and from that position, what they're looking for, what's important to them, all that kind of stuff. So, just continuing to do what we do, keep the blinders on to some extent, because there's something to be said for that. There's a lot of opportunity in workforce and affordable housing, not only in our markets, but all throughout the country, not only in single family, but in multifamily, existing and new development, all that kind of stuff. But then also look for diversification. And, I love industrial. I think there's something to be said for that, and self storage and other things like that. So just every I like to be the dumbest guy in the room. I always like to be pushing myself. And I always think it's funny, like on social media, some people are very, very cocky, very confident, and that kind of thing. And every day in real estate I feel dumber than I did the day before. I realize every day how little I know at the end of the day. It's just there's so much you can do in this business within, like we said, there's three in capital acquisitions and execution. There's so much you can do within those three buckets. There's so many different asset classes, and then within each asset class, there's so many different ways you can take the business and all. It's just every day, I'm just blown away by how little I know. That kind of thing. So I hope to continue on that way and continue to educate myself and stick to kind of my plan and the goals, but also, as you bring in new information and new intel, not be be willing to change and ebb and flow with it as well. Kind of that create that balance.
Really great answer. So the last question I have for you that isn't on the script, and I love throwing this one out because it's total curveball
I
time.
didn't read the script, so these were all new to me.
Even better, even better. How spontaneous
It'll
could
be
you
more
be?
fun that way.
Yeah, I'm having a blast, and I thank you. So
Thank
the
you.
last question I ask is, what's the question on today's show I should have asked you that I didn't?
Wow. Good night. I mean, that is a really good question. Um, hmm, God, that's a thinker. Whew, I don't know. I don't know. I mean, I was gonna say why single family, it's not you're a multifamily guy. I mean, I thought when you said that in the beginning, I thought, oh, here we go. We're going to be duking it out over single family versus multifamily or something like that. But, and I was ready for the fight. But, but now I'm not like that. A lot of multifamily guys could be that way, right? Where what they're doing is the best thing or something like that. I think diversification at the end of the day, a diversified portfolio is a good portfolio. And if whether you're passive or you're active, you got to find ways to diversify your portfolio. But yeah, I think, and we did speak about it a little bit, with what we do with single family, that kind of thing. So that was one question I'd say I was surprised didn't come up. But yeah, other than that, this was a great conversation. You stumped me there.
Well, if you would have given me the question that I should have asked, I was going to ask you the question.
Well, there you go. Okay. Maybe I answered it the
That was
best way
good.
then.
Yeah, and I didn't have to ask why single family because you made it clear why you were doing what you were doing. You put it in the buy box, you did it in the fund, and we've had guys who've come on and bought portfolios. Okay, they were buying smaller multifamilies, but the same principle, right? If you got a
Sure.
box of properties, you could have always, I mean, you're going to fix them up and turn them into inventory. That's your model, which is wonderful. But if there was some that, hey, this box has 30, we're at 20 and the fund meets, you could have sold off the other 10 at a higher profit than you would have bought them for. That
Sure.
investor would have been thrilled because they're getting something that you touched and made wonderful that they don't have to deal with as a fix and flip. So yeah, I mean, John Bombachi, he was buying boxes of portfolios, and he didn't care that there were dogs in with the diamonds because
Sure.
he already earmarked the dogs to sell at a higher profit than he was buying them for
Yeah.
to investors who still had meat on the bone.
Yeah, that's how the distressed mortgage business works. 100%. I mean, you get the baby in the bathwater. You're not going to. Not every deal is going to be a home run, but there's going to be some grand slams in there, and a lot of singles and doubles and triples that'll make up for the few that maybe aren't the best. And sometimes depending on where you're buying them and all, you have to, in order to take down that tape. That you have to get. It just comes with the package. You know what I mean? So, definitely.
I think you did a great job answering the questions. A wonderful story. Can't wait to get this one out there. For all of our peeps on this podcast, maybe investors, maybe people who want to reach out to you, how would you like our listeners to get in touch with you today, Peter?
Sure. I would start with the website gsprei.com. They could schedule time with me on there. My phone number's there, emails there. So, it's a good place to get started. There's information on our funds. There's a learn section where we get into all kinds of different stuff. And, so I would start there and then, I do some stuff on LinkedIn, that kind of thing. But start with the site. And I always like to say, don't hesitate to reach out. I'm always open to a conversation and seeing where it may lead. And there, coming from my mom as a school teacher, she would always jokingly say, people say there's no stupid questions. She would say there is, but as a school teacher for 30 plus years, you've heard some stupid questions, but there isn't, especially in real estate. I mean, don't be afraid to ask. Yeah, that's such an important. I would never knock anybody for calling or reaching out or anything like that, with no matter what they wanted to talk about, because that's such an important skill in this business, being able to pick up the phone and have a conversation with somebody, and make a connection. It's important. So it's something I take seriously. So I would say start on the website and don't hesitate to reach out from there.
Excellent. Peter, Neill, I want to thank you so much for being a guest on our show today. Any last words before we sign off?
Oh, Brian, it was great to be here. I had an awful lot of fun with you, and and your real estate peeps, and I'm looking forward to continuing the conversation. I feel like we could have went in a lot of different directions, and also a lot to talk about. I had a great time with you.
Excellent, Peter. Thank you so much. And for all of my real estate peeps, pleasure being with you today. This is Brian Lucier from the Why Not Real Estate Podcast signing off, and we'll see you on the next one.